Never depend on a single income. Make investment and create a second source. Hello everyone. Thank you so much for clicking on my video. My name is Anamika Chauhan. I am studying in BCom Financial Services Semester 5 in Hansraj Mahila Mahavidyalaya, Jalandhar. So, I am here to give my seminar on topic mutual funds. Before beginning with my seminar, I would like to express my deepest gratitude to my Honorable Principal Ma'am, Professor Dr. Mrs. Ajay Sareen, for being an excellent teacher and mentor to each one of us. And my teacher in charge, of course, Mrs. Kajalpuri Ma'am, for sharing love and passion for education with me, supported me, and provided this chance to learn many things about mutual funds. So, again, thank you very much, ma'am. So, let's begin with the seminar. Here we have content, introduction, history of mutual funds, myths about mutual funds, facts about mutual funds, classification, how to invest in mutual funds, advantages, disadvantages, systematic investment plan, riskometer, and conclusion. So next we have introduction of mutual funds. It is a trust that collects money from a number of investors who shares a common investment objective. A mutual fund is a collective investment vehicle that collects pool money from a number of investors and invests the same in equities, bond, government securities, and in the market. In short, mutual fund is a collective pool of money contributed by several investors and managed by a professional fund manager. Mutual funds in India are established in the form of a trust under Indian Trust Act 1882 in accordance with SEBI Mutual Funds Regulations 1996. The fees and expenses charged by the mutual funds to manage a scheme are regulated and are subject to the limits specified by the SEBI. Now we will start with the history of mutual funds. The mutual fund industry in India started in 1963 with the formation of Unit Trust of India at the initiative of Government of India and Reserve Bank of India. The history of mutual funds in India can be broadly divided into four distinct phases. The first phase is from 1964 to 1987. The mutual fund industry in India started in 1963 with the formation of UTI in 1963 by an Act of Parliament and functioned under the regulatory and administrative control of the Reserve Bank of India. At the end of 1988, UTI had Rs 6,700 crores of assets under management. Now let's discuss about the second phase. Second phase was from 1987 to 1993. Entry of public sector in mutual funds. LIC established its mutual funds in June 1989, while GIC had set up its mutual funds in December 1990. At the end of 1993, the mutual fund industry had assets under management of Rs 47,004 crores. Now come on to the third phase of mutual funds. It was from 1993 to 2003. Entry of private sector to mutual funds. The Indian securities market gained greater importance with the establishment of SEBI in April 1992 to protect the interest of investors in securities market and to promote the development of and to regulate the securities market. The number of mutual fund houses went on increasing, with many foreign mutual funds setting up funds in India, and also the industries has witnessed several managers and acquisition as at the end of January 2003, there were 33 mutual funds with total assets of Rs 1,21,805 crores. The Unit Trust of India with Rs 44,541 crores of assets under the management was way ahead of the other mutual funds. Let's talk about the fourth phase of mutual funds since February 2003, April 2014. In February 2003, following the repeal of Unit Trust of India Act 1963, UTI was divided into two separate entities, like the specified undertaking of the Unit Trust of India and UTI Mutual Funds, which functions under the SEBI Mutual Fund regulations. Now, the second is the UTI Mutual Fund sponsored by SBI, PNB, BOB, and LIC. It is registered with SEBI and functions under the Mutual Fund regulation. With the verification of the arrest file, UTI, which had in March 2000 more than Rs 76,000 crores of assets under the management, and with the setting up of a UTI mutual funds, conforming to the SEBI mutual funds regulations, and with recent managers taking place among the different private sector funds, the mutual fund industry had entered its current phase of concentration and growth. Now on this page, you can see the graph indicates the growth of assets over the years. You can see that the graph is growing day by day. Now we will see about the myths about mutual funds. Mutual fund invest only in shares. No, mutual funds don't only invest in shares. Mutual funds are prone to very high risk. Mutual funds are very new in the financial market. No, as you have seen the history of mutual funds, they are from very long time in the market. Mutual funds are not reliable and people rarely invest in them. So many people are there who invest in mutual funds. So it's not true that rare people invest in them. The good thing about mutual fund is that you don't have to pay attention to them. Yes, it is very good thing that you don't have to pay attention to them, as you have a fund manager and he will take care of your money. So now let's move on to the facts about mutual funds. Equity instruments like shares are only a part of the securities held by the mutual fund. Mutual funds are also invest in debt securities, which are relatively much safer. So we have two things, equity and debt. Equity will give you higher profit, but they are risky. And debt will give you lower profit, but they are safer than equity. So mutual fund invest in both. So our risk will be covered, so our loss will be covered because our money is managed by the fund manager. So now next point. Mutual funds are there in India since 1964. So it's from very long time. Mutual fund market has evolved in USA and is there for the last 60 years. Mutual funds are the best solution for the people who want to manage risk and get good returns. Classification of mutual fund is divided into three parts: based on structure, based on investment objective, based on investment styles. Under the based on structure, we have 3 points: open-ended funds, closed-ended funds, interval funds. And under the based on investment objective, we have 3 heads: debt funds, equity funds, and hybrid funds. And next, based on investment style, we have 2 heads: passive funds and active funds. Now let's talk about the classification based on structure. Open-ended funds will give you no fixed maturity date except continuous sale and repurchase request. And transactions are NAV based. Unit capital is not fixed. Closed-ended funds run for a specific period, offered in an NFO, but are closed for further purchase after NFO. Unit capital is kept constant. Interval funds, variant of closed-ended funds, become open-ended at a specific intervals. Have to be mandatory listed. Next, let's talk about classification based on the investment objective. First, debt funds invest in short and long-term debt instruments, aim to provide regular income. Equity funds invest in equity securities and aim to provide growth and capital appreciation over a long term. Third is hybrid funds invest in a combination of equity and debt securities. Proportion of equity and debt may vary. Aim to provide for both income and capital appreciation. So now next, classification based on investment style. First is passive funds. Replicate a market index, invest in same securities and in same proportion as that of the index. No active selection of any stock or sector. Expenses are lower. Portfolio is modified every time index composition changes. Second, active funds. Invest in securities and sectors that may offer a better return than the index. Actively manage and allocation of market securities and cash. May perform better and worse than the market index. Incur a higher cost than the passive funds. Next, how to invest in the mutual funds. We have 4 ways to invest in the mutual funds. First, via online mode, website of mutual funds, or via AMFI registered mutual fund distributor using physical form online mobile app. Via mobile app of mutual fund, via physical mutual fund application form. Next, how does mutual fund work? First is investor, then fund manager, securities, returns. You can see in the chart. Next, advantages of mutual funds. First is advanced portfolio management. When you buy a mutual fund, you pay a management fee as part of your expense ratio, which is used to hire a professional portfolio manager who buys and sells stocks, bonds, etc. This is a relatively small price to pay for getting professional help in the management of an investment portfolio. Next is dividend reinvestment. As dividends and other interest income sources are declared for the fund, they can be used to purchase additional shares in the mutual funds, therefore helping your investment grow. Next point is risk reduction. Reduced portfolio risk is achieved through the use of diversification, as most mutual funds will invest in anywhere from 50 to 200 different securities depending on the focus. Numerous stock index mutual funds own 1000 or more individual stock positions. Next point is convenience and fair pricing. Mutual funds are easy to buy and easy to understand. They typically have low minimum investments and they are traded only once per day at the closing net asset value, NAV. This eliminates price fluctuation throughout the day. Now we will talk about the disadvantages of mutual fund. First is high expense ratio and sales charges. If you are not paying attention to a mutual fund expense ratio and sales charges, they can get out of hand. Be very cautious when investing in a fund with expense ratio higher than 1.50%, as they are considered to be on the higher cost end. Second is management abuse. This includes unnecessary trading, excessive replacement, and selling the loser prior to quarter end of the fix the books. Next is tax inefficiency. Like it or not, Investors do not have a choice when it comes to capital gains payouts in mutual funds due to the turnover, redemptions, gains, and losses in the security holdings throughout the year. Investors typically receive distribution from the fund that are an uncontrollable tax event. Next is poor trade executions. If you place your mutual funds trade anytime before the cutoff time for same day NAV, you will receive the same closing price NAV for your buy or sell on the mutual fund. For investors looking for the faster execution times, maybe because of short investment horizons, day trading, or timing the market, mutual funds provide a weak execution strategy. Now let's talk about the investment modes in the mutual funds. First is lump sum investment. Second is systematic investment plan. In lump sum investment, it is a one-time investment. Usually, large sum of money is invested in one go. Investors face risk of volatility in markets. Systematic investment plan is a period of commitment 6 months, 1 or 3 or 5 years. Specific intervals monthly, quarterly, half yearly, or made on a specific dates, that is 1st, 5th, 10th, or 15th of every month. Now let's talk about the systematic investment plan. Systematic investment plan, which is very helpful to salaried and middle class men. It is just same as like LIC or doing an FD, fixed deposit. They can invest their savings into systematic investment plan and collect huge funds for future. SIP is paid in monthly or quarterly as per the scheme. Opting SIP, an investor can invest their savings into it and can save his money doing that. SIP is good because if it seems that market will goes down in few days, so investor can safely withdraw his money and can save his money. Next, advantages of investing in SIP. Financial discipline. Second, flexibility. Third, convenience. Fourth, lower risk. Now let's talk about disadvantages of investing in a SIP. I have not explained about the advantages of investing in SIP, as you can know this from any financial advisor, but they will not talk about disadvantages of investing in a SIP. So I will tell you about disadvantages. First, even though SIP has disadvantages, but it still seems to be one of the best investment option available to a long-term investor. Second, it particularly suits first-time investors in equity and those who do not have a lump sum or the time to track their investment. Means it is good for those who don't have enough time to look onto the market fluctuation, or they don't have enough time to look onto their phone and see the market fluctuation, or the market is going up or market is going down. So this is good for them. The salaried class should also opt for the SIP since it becomes a good saving habit. Investors who do not wish to be stressed by the market should adopt the rupee cost averaging method for secured long-term investment planning. We usually invest in fixed deposit, LIC. We do so many things. So this is a very good option to save money and make money from money. So let's invest in SIP. Next slide is about riskometer and its importance. Here are 6 levels of risk for a mutual fund scheme. First is low risk, low or moderate risk, moderately high risk, and very high risk. Next, so here I conclude by saying mutual funds are one of the best investment options available in the market for investors. There are mutual funds suitable for every investor, and the individuals must assess their requirements and risk profiles before picking any. Before winding up my video, I would like to ask one question from all of you. How many millionaires do you know who have become wealthy by just investing in saving accounts? I rest my case. Thank you.